Well, hello everyone. Welcome to Getting Started with Options. My name is Barbara Armstrong. I am a coach and senior manager with Charles Schwab, filling in for Cameron May today. And all I can say is that I am thrilled to be here. Actually, I designed this class, I don't know, probably almost 10 years ago and taught it for several years. And it still, has a special spot in my heart. So I am going to be talking about buy right covered calls today. And one of the reasons I chose that is because I've been filling in for Cameron in his covered call and short put class on Mondays the last couple of weeks. And this was a strategy that when I first started, it was counterintuitive to me. Like, why would I consider buying shares of stock and selling, which is bullish, and then selling a covered call, which is kind of a neutral-ish strategy, I thought, at the same time. And it was Cameron May that said to me, because you could potentially earn a return of like 1 to 10% in a 15 to 50 day time frame. And I said, and I'm listening. And so that really piqued my interest. And this is a strategy now that I love to talk about. And so that's what we're going to focus on today. If you are not following me on X, you're going to want to do that at Barbara Armstrong, at Barb Armstrong CS. We also have Mike Fairborn with us in the chat. And Mike's handle is at Mike Fairborn CS. Excuse me. You can now also find us on LinkedIn. So head over to LinkedIn and follow us there. Now, just before we get into, the thick of talking about buy rights, just a quick reminder that everything that we cover here is for general information purposes only, none of it to be construed as a recommendation. Know that options carry a high level of risk and aren't suitable for all investors. Also, we are using the paperMoney platform on the thinkorswim desktop platform, which is an excellent place to learn. And just make sure that you have a trading plan in place, that you understand the strategy, that you understand how to place trades and how to place exits on trades, before you consider trading in your live account. Now, one of the things that's different between a paperMoney account and a live account is that short option positions will never be called out early. And a covered call is a short option. Short just means sell, my friends. So, and we're going to talk about, what that might mean for us as we, consider using this buy right covered call. So we're going to look at what a buy right covered call is. We're going to identify some potential entry signals, what an expiration date, why we might choose one expiration date over another, look at strike prices, discuss a bit of how, we might manage these as we go in, and then we're going to play some example trades. So that is what is on the menu. That is what's on the menu today. Now, like, is this an oops? No, it's not an oops. I did this on purpose. I put in a blank slide because before we get into the mechanics, I taught a class on buy rights yesterday in the buy right and covered call class. Oh, you know what? I was posting some stuff on X, so we're going to now use yellow. But I wanted to talk about a buy right. So this idea is that if we have a stock that, say, it's been uptrending, or it could have been going sideways, and then, we've had a horizontal resistance breakout. This idea that with a buy rate, one of the ways we can do this is to say, okay, it's pulled back, it's starting to move again. So I am going to buy the stock right here. And let's say it's trading at $94. And then I'm going to sell this covered call at 105. Oops, I can write at 105. And let's say I get paid $2.50 for this covered call. So now I'm capping my gain. Like, the most I can make on this trade is $105 a share. Plus I got, if I sold this call, and I'm getting paid for that. So if we look at this, and this is just an example, I could make $11 on the appreciation of the stock, plus I can make $2.50. But I'm selling this with the expectation that it's going to run through my strike and I'm going to get called out. So if I were called out prior to expiration, would I be sad? No, I would be thrilled. And why would I be thrilled? Well, because I've now got my max gain. So, and you know what? Like, let's say that the stock goes up to 110. Am I going to be sad? Well, no. Like, I paid my net entry on this was, say, 91.50, 94 minus the 250. And if I get called out at 110, I've just made a really nice return. And I've had a conversation with myself before I placed the trade and said, hey, if this happens and I get called out, am I okay with this return? So if I took 110 minus 91.50, that's an $18. Now, this is probably not realistic, to make 18.50. But 1850 divided by 9150, that would be a 20% return. Now, what we're more likely to see is something from, say, 2.5%, depending on where our expiration dates are and how volatile the stock is, to maybe in that 10% range. But for a short-term trade, that's not too shabby. Now, when else might we consider it? Well, let's say something's going up, and we did this on, I think it was, we're going to look at this on Intel yesterday. So it had come up, and we had this candlestick pattern that was indicating that it might pull back. And so we talked about, if I buy the stock here at a high when it looks like it might do this for a few days, why would I consider doing that if I don't own the stock? Well, because if I both buy the stock at this price and then I can sell a covered call higher and get more for it, then if it pulls back to, let's say, this previous support level and bounces, I could sell my covered call here, and, so enter it here and buy it back here. Now, what if it doesn't continue to pull back? Because this is a candle pattern that requires confirmation. It's not saying, so if we wanted to place a bearish trade, we would wait for the next day for confirmation. Well, what happened? What happens if it gaps up and goes through my strike? Well, I agreed with myself that I would be totally cool with that and being called out. Yeah, so Mike is saying I always talk to myself. Yeah, no one else listens, so I cut out the middleman. That's hilarious. I call it the divine trilogy. Me, myself, and I. Yeah, so I have these conversations with me, myself, and I. And so this is another reason we might do a buy right covered call. Now, what's the third reason? Now, part of your trading plan, and I've posted an example trading plan in the chat, and if you're watching this in the archives, I'll post that example trading plan in the archive as well. And there'll also be a link to it at the end of the webcast. But let's say earnings is coming. So like today, earnings is coming today. So let's say you're expecting it to continue to go up and it's close to a high. If I sell this covered call and it gaps down, let's say I got $5 for this covered call, it will kind of ease the wound. But it's not like, if it were to gap down dramatically, it's not going to eradicate all of your loss. The other thing we could do is we could sell a call here and come out a few weeks, and then use part of those proceeds to buy what we call a protective put. Which gives us the right to sell the stock at that price. Okay. Yeah. So that's another reason, and we might do this when we have earnings coming up. Okay. Now, with a covered call, what's the difference between that and a covered call? Well, I'm glad you asked. So, with a covered call, we already own the stock. And typically it's 100 shares per contract. And so let's say we have a stock that has been going sideways now for quite a while, and the video was going sideways. And then it kind of, it was kind of going like this. And so you might say, like, I believe in NVIDIA long term. And I'm just talking here, like this isn't a recommendation. So it comes up, comes down. You could say, well, I'm going to sell a call when it comes up and bonks its head and rolls over, and then I'm going to buy it back here. And then when it comes back up, I'm going to sell another covered call here. And when it comes back down, I'll buy it back. And then I'm going to sell another one here. And this thing went from like September to the end of April. And so, we could do that, but you never know when it's going to break out. And then you can either try and roll it, or you could just say, you know what, I'm okay with selling it. But, keep in mind with a covered call, you can be called out at any time. You can be called out at any time prior to expiration, on most stocks. So, this is a reality. And if you're saying, like, hey, I got this stock from my grandma, or, like it will be a significant taxable event if I sell it, I don't want to sell it, well, then don't sell a covered call. But, selling covered calls is often a way to generate income when a stock is going sideways, or if you think a stock might be suffering, might suffer a short-term setback. If you think that the stock is, going to start downtrending in a major way, one might question whether or not you want to continue to own it, right? Okay, so are there any questions on that? Okay. Yeah, so somebody saying is something that blew his mind was that, if you buy an out of the money call, you can still be in profit. And Yarrick, that's true, but that's a conversation for another day. Because today we're talking about selling covered calls. We're not talking about long calls, and long is buy. Long means buy. Okay. So there's kind of the wet your whistle part of it. So, like, to technically define a buy right, oops, sorry, I just hit the wrong button there. Cancel. Okay. So to technically define, let me just get out of this. Okay, sorry, guys. I can work my keyboard. Okay. So this is, to just review, we're both buying the stock and we're selling a call at the same time. And when we sell a call, what it says is, hey, if you'd like to buy my stock from me at this price, at say 105 or whatever the price is, you're welcome to buy it from me at any time up until expiration. And so if it gaps up and above the call we sold at 105 and goes up to 125, the odds of being called out are higher, and they're higher as we approach expiration as well. But if we're called out, we're not going to get the 125, we're going to get the 105. Yeah. So this is, it's similar to a covered call where, you might call it we're legging in. The difference is the timing. With a buy right, we're both buying the stock and selling the covered call at the same time. Okay, and that's what makes it different. And it's also sometimes different in what you're hoping to achieve. And so, like, I met someone in Chicago a couple of years ago, And, I asked him, if he was getting what he wanted out of it. And he said, well, I want to make 6 figures a year with my trading. I want to generate an income. And I said, is there a strategy you like? And the strategy that he liked was a buy, right, covered call. But he didn't know how to protect himself to the downside. And so I said, well, just put in an exit. And he said, well, I can't do that because if I sell the stock, then I'm left with a naked call, which has unlimited risk. And so I'm going to show you how to do that. But, know that, you can there are people that will use this strategy as a short-term income generating strategy. And yesterday we were talking about that. You might put this into your, Paris for Christmas fund, or buy a new car fund, or pay off your credit card fund, or, like maybe you're trying to generate an extra, $100 a week, or 500 or 5,000 a month. Like, I don't know your goals or your account size, but this is not a long-term love affair. This is a short-term growth or short-term potentially income generating strategy. But here are a few things to keep in mind. That early assignment can happen at any time. And if our goal is to be called out, that's not a bad thing. In fact, that could be a cause for celebration, and that some people will have their trading plan will say, I want to avoid earnings, or avoid dividends where, the risk of being called away is higher. Now, in our case, if we get called away, are we sad? No, we're not going to be sad. We're actually, we're going to be totally fine with that. And, when volatility is higher, premiums are higher, right? So this is a strategy that has more appeal, but then we've got to be aware, and we've talked about this, there may be tax implications if you sell the stock, depending on the type of account it's in. And, for that, you've got to, talk to your accountant about that. Okay. Okay. So, what might be good candidates, what stocks, and we've already talked about this. So, we could use this with a stock that's in a sideways trend. We could enter the trade when it's bouncing off a resistance area. And for me, these entries are more kind of conducive to a covered call strategy where the goal is not to be called out. So some might, whoops, thought I changed my drawing tool. Some might say, I'm looking for something that this is covered call with a buy right. You might say, I'm going to trade this a little differently, and I'm looking for something that's bullish. And I'm looking for something that is uptrending. I'm just going to draw an arrow. That's uptrending. But these are the same. And so, I created an example trading plan, and like, nerd alert, like when I first started, I created a checklist, and I would pull out that trading plan and I'd go, okay, so is the stock uptrending? Check. Is the sector uptrending? Check. Is the market uptrending? Check. Does this stock have high trading volumes? And we might define that as 1 million shares a day plus. So you might say, well, I want it to be 5 million a day plus. It's your trading plan. You can make it whatever you want. Yes, I do have a trading plan for buy right covered calls. I've posted one, and I'll show you where that is. So, and I want the options to have high trading volume. So open interest is number of contracts that were on the books when the market opened, volume, number of contracts traded today. And we might say, we want that to be at least 20 times the number of contracts that we're going to trade. And then we also want our options to have tight bid-ask spreads. And, we might say, well, we're defining that as less than 10%. So if the option is $5, we want the bid-ask spread to be less than 50 cents. Okay. So there's, if we're trying to put a trading plan together, this might be in our when to buy, what to buy. Okay. So let's go out and look at a couple of stocks. So, and I thought we'd start with Apple, which is ironic because James, I was just in the last class on the chat and I had put this on my list today. Um, and, James, I think, had an example trade. So great minds think alike, or he at least talked about Apple. And so when we look at this, this is on the other side of earnings. I posted something on Apple earlier today. And if we come over here and I've linked my live news to my chart. And so if I have Apple up and we scroll down, it obviously had a pretty positive earnings report because it gapped up the next day. And then if we scroll down, because there's always a lot of news on this, well, it's trading at 280. UBS raised their price target to 296. TD Cohen to 335. There were several here. It's interesting to me how varied they can be. So here we have Barclays at 253, which it's trading well above that. And Wells Fargo moved their price target to 310, which is way up here. B of A to 330, which is off the chart. So it seems to be that 300 plus range is the most popular, but who knows? These guys do this for a living, but it doesn't mean that, they're necessarily right. But that's the sentiment. And so we look at it, it's like bullish sentiment here. We had a pennant pattern setting up. We had a breakout and a retest, and then it gapped up on earnings, a one-day pullback. And today, if we zone in, this is almost a bullish engulfing type pattern here. So, and if you're saying, if we're looking for a close above the high of the low day, well, if this were to close right now, this would be closing above the high of this low day. So our high yesterday was 280.63. We're currently trading at, 283.21. And so when we look at our what to buy or when to buy, we have that. Now, so is this uptrending? Then if we take a look at the sector, and if I come here to sector indices, and if part of our example trading plan says, well, is the sector uptrending? So I brought up the sectors. Here's technology. Well, it's hitting a new high today. So it's hard to say it's anything other than uptrending, right? And how about the general market? Well, if we use either the SPX, new high today, well, I guess this would be a new all-time high close, although for an intraday high, Friday is currently in the lead. But if it closed where it is now, that would be a new closing high. NASDAQ hitting a new all-time high today. So check, check, check. Now, this is Apple. So let me just bring Apple back up. If we come to the trade tab, does it trade more than 1 million shares a day? Check. Does it, if we come out to June, now we're 44 days out. So here we could say, like, if we want to do a shorter time frame and say we're at 281, let's say we want to come to the 290. If we come out 17 days, well, let's do 24. If we come out 24 days to the 29th of May, even on these weekly options, we've got a, at the 290, we've got a 10-cent bid-ask spread, thousands of contracts in open interest. So check, check, and check. Now, if we come out and we look at, like, let's say we said if it goes up $10, we'd be cool to make a little money in a short amount of time. If we come out to June and look at the 290, June 18th, we're in it for double the time. We're not making quite double the money. And so this is where you have to have this conversation with yourself. And then we've got, way more contracts and a 5-cent bid-ask spread. And so if we look at this and we say, okay, if I look at the chart, our previous high here was 288. So if I look at this and say, well, if it comes back up and it seems to have some momentum behind it in the next 3 weeks, I'd be okay to take less and be in the trade for, 3 weeks less, 20 days less. And then if I'm called out, I could do it again. I could wash, rinse, repeat. Okay. So if we look at this, we're going to right click, and in thinkorswim parlance, this is called buying covered stock because we're buying the shares and we're selling a covered call. So what's the most we can make here? Well, the most we can make, and let's switch our gadget to a calculator, is the 290 minus what we're paying to get in. So we can make 290 minus 277.60. Oops, I obviously didn't type that right. 290 divided by 1 minus 277.60. It's $12.40. And if I divide that by the 277.50, shoot, okay, we're off by a decimal. So, I slipped a decimal point there. So it's almost 4.5%. So if we look at this and we say we're bullish on Apple, it's a heavily traded stock, I would be okay with a 4.5% return in 24 days. Now, where might we put a stop? Well, if we're okay with owning the stock, and this is where some people kind of struggle, but they might say, well, if I look at it broke out and it kind of came back into this neighborhood to retest, I would go 3% below here. Now, if you're okay with owning Apple a little longer, you might make your stop below here, because it spent kind of a week skidding along this line before it took off. So, but if we use 275 and we go 3% below that, on Apple, we'd put our stop at 266.75. Now, per my friend in Chicago, how do we do that? Well, we're going to come to single order. We're going to make it a first trigger sequence. We're going to right click, create an opposite order. We're going to make it a market order. That's good till canceled. And we're going to say, we're bringing up our conditional order sprocket, and we're going to say, hey, if Apple goes at or below 266.75, we want out. Now, we don't know exactly what that call will be worth. It will be worth less than what we're paying for it now, one would assume, unless there's a massive spike in volatility, but it would get us out. So the most we can make on this is $1,229. And then what are we risking? We're risking in that neighborhood of $1,100. Now, is there any guarantee that we're going to get out at exactly that price? No, if Apple were to gap down, we could end up out lower. But we're going to put that in our buy right covered call group. And for our $500,000 account, this is an acceptable position size and an acceptable amount of risk. We don't want to risk more than about $2,500 on any one trade. And so we're honoring that. And then, if we could make $1,229 and put that towards our, Paris for Christmas, or, Disney with the kids trip, or buy a new car fund, or whatever it is, that would be nice. And, for this person that I talked to, whose goal was to make $100,000 a year, that's $2,000 a week. And not all trades are going to work out. So you might say, well, I'm going to try and do, have enough trades in the hopper that I could aim for 2,500 a week, knowing that some weeks you're going to end up in the hole, or some weeks you may not make that. And then when you have a really great week, how did I pull up the conditions tab? So Darius, so let's go ahead and send this in. And then when we come to, so let me just bring this up again, our covered stock, single order, first trigger sequence, right click, opposite order. And then beside best, there's this little disappearing, reappearing sprocket. You hit that. Okay. So that's how we pull it up. Now, I do want to place another example trade, but I also want to talk about trade management, because the one I was talking about, I actually taught in the class yesterday, and we're up $1,200. So this was Intel, and we sold the 105 call, and it's now trading at 108. So the most we can make on this stock is how much on this trade if we were to be called out? So if we were called out, the most we could make on this is 105, right? Minus 94.20, which is what we were paid to get in. And so that is, I already did the math, 1080 a share. And we did 2 contracts. So then we would multiply that by 200. So this is the most we can make on this trade is 2160. And we're halfway there. Even though it's deep in the money, we've got half of our max gain. And so we may not want to close it out, but what the market giveth, the market can taketh away. But when we place this trade, we said, if it gaps up, we're okay with being called out. And if it pulls back for a few days, we could buy back that call for less. And that was kind of half what we were expecting, because we placed the call yesterday and we thought like, hey, if this pulls back for a few days, I'm totally cool with that. Maybe I can buy it back, and then it starts to bounce. I can buy it back for maybe half of what I paid for it. And then when it comes up here, I can buy another one. Well, that's not how it worked out. It blew right through our strike. It's now trading at 108. And so we're $3 in the money. So if we are not, if we're called out tomorrow, are we going to be sad? No, we just made $2,200 in 2 or 3 days. We would be thrilled. Now, what else could happen? Well, it could, let me just shake my Etch-a-Sketch here. This could pull back below that 105. And this is only 11 days out. And so if it pulls back, it could end up expiring worthless. And our deal with ourselves might be like, hey, if this gets to the point where we've got 80% of our max gain, we might just buy it back and close it out. If we're called out, we've made a really nice return in a short period of time. And are we okay with that? We're okay with that. Okay. Okay, so let me just close this. And as a percentage, if we look at that trade on Intel, sorry, let me come to the monitor tab. It was 1080 was our max gain potential, and this is unrealized, divided by 94.20. So that's over 10%. That's over 10%. If we could make that in 2 weeks, sign me up. Okay. Now, I filled in for Cameron a week ago yesterday, and we did this trade on AVGO. And so this one also, we did the 430 call. It's just kissing it. If we are called out, are we sad? No. Because, we're looking at, we paid 400 to get in. It's now trading, the most we can make is 430. This expires in 17 days. so if we're saying the most we can make is, say, I'm rounding, it's 29.60. The most we can make is $30 a share or 3,000. We're at 11.21, even though it's flirting with being in the money. And so this might be, Barbara's saying, how often do you review this? This is not an account that I actually actively manage, although I'm teaching so many extra classes right now that, I am looking at this more. But if this were in your paperMoney account, I would look at this daily. I just have a quick peek. And so you could say, okay, well, let's go have a quick peek at AVGO. Personally, I'm a very visual person, so I like to look at the charts. So I'd look at this, I put a circle around, we place the trade this day, and here's where it's currently trading. So if it goes through, we could consider rolling it out. We could let ourselves be called out. When we've got 80 or 90% of our max gain, we can, we can just close out the entire position. So Hiron, just a sec. Somebody's lost. Yeah. Yeah, hit refresh. If you can't hear me, my saying it isn't going to help. Okay, so that's AVGO. So that's a little bit of the thought process behind trade management. And we went into more detail in yesterday's class, so I will put in a link to that class as well. Now, how do you find that class? Well, if you come here, if you haven't subscribed to Trader Talks, here's my what's going on, why haven't you? You can click in the bottom right corner and subscribe to the channel. It's free to subscribe. And you're going to want to come to playlists. And when you come to playlists, you're going to want to scroll down and look for the trade management mini sessions. So when you come to these trade management mini sessions, if you're new to candlesticks and technical analysis, there's a whole series of short videos on candlesticks. So you're welcome to do some binge learning. Then here are the example trading plans. And here's one for the buy right covered call. So you just click on that. It's 20 minutes long. I've already posted it. So, and I'll repost it in the chat. Yeah, but these are really handy. It just provides a framework from which you can then create your own trading plan. And literally you can go through and go check, 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 check. And it covers what to buy or, when to enter the trade, what to buy, like what to trade, when to trade it, how much to trade, so position sizing, when to exit, both if the trade goes for you or against you, and then what are your routines. Okay, so the other thing I wanted to point out, if this topic is of interest to you, is look for the playlist on covered calls and short puts, because I did that call yesterday. And so you can come in and just look at that. And we went into more detail on trade management. Okay. Okay, so that's that. So let's go and place another example trade. So today is officially sponsored by the letter A. Can you tell I was a fan of Sesame Street when my kids were young. I still am a fan of Sesame Street. So this is kind of more like the intel. So, would this have been a valid entry, the day after earnings here? Yes. It gapped up on the open, pulled back, moving to the upside, hitting a new all-time high today. So this is the thought process. If it pulls back like Intel we thought might have, we could sell this covered call, get more, and then buy it back when it comes back, and then sell another one. Because remember, we're doing this with the thought in mind that this is a dating strategy, not a long-term love affair. And so if we come to our trade tab, we could say, well, we're hitting a new all-time high today, so we aren't going to make it a swing target, but it's at 273. How about if we came out to this 280 and just did a 10-day trade? or came out to May 29th and this 280, we get $5.40 for it and say, okay, if we buy our covered stock, we've got lots of volume here. We've got lots of volume here. We've got a 20-cent bid-ask spread. So check, check, check. We have a bullish trend. The market's bullish. Amazon is in the consumer discretionary sector, also bullish. So the most we could make on this is about $12 a share. And I'm rounding in the interest of time. So 11.80. So if I took 11.80 and I divide that by my 268.20, that's a potential return of 4.4% in 24 days. Now, we could end up losing on it. So, where might we put our stop? We might say we're going to put our stop 3% below that 255.65 times 0.97. We're going to put our stop at 247.98. Again, first trigger sequence, right click, opposite order, market, because we don't know how much that option is going to be worth. Good till canceled. Click beside best, the disappearing, reappearing, conditional order, sprocket. Amazon, if it goes below 247.98, we want out. And position sizing, we're cool with a position 5% of the account value. This is the original account value, was 500,000 in this paperMoney account. And so the most we can make on this, pretty similar to the last one, like $1,200. Now, this doesn't recognize that we have a stop in it saying, hey, if Amazon were to go to zero in the next 24 days, that's what you'd be down, 26,807. We have a stop in, again, no guarantee that it wouldn't gap down past our stop and get us out for a bigger loss. But 247, 268, we're risking just over 2,000, but we want to give it more room. And the reason, some people might say, well, that's like I'm risking more than I can make. But if we look at that stop at, say, it's between 245 and 250, what's the probability of being called out in the next 24 days? You have a 14% chance of it hitting 250, or sorry, a 27% chance that it can come down and kiss 250, and our stop is below that. At 245, you have a 1 in 5 chance, a 20% chance, a 10% chance of it closing below. So we're trying to create a stop that won't nick us out and then just go back up again. So we did 2 example trades. We talked about some trade management. We did one on Apple. And this one hasn't filled yet. So if you're saying, oh, okay, they want us to pay a little bit more, if we're okay with that, we'll just cancel and replace. Put it a little more in the middle. And I'll make sure these fill. And if I fill in for Cameron again, we'll follow up on these. But as I wrap, I want to thank Mike for all his help in the chat. Make sure that you follow us on X, Barb Armstrong CS, Mike Fairborn CS. Find us and follow us on LinkedIn as well. Hit the like button. It helps move this up in the algorithms on YouTube so more people can find this content. And subscribe to the channel if you haven't done that already. If you haven't had enough of me today, long options is up next, but then I'm coming back with getting started with technical analysis. Today we are talking patterns, my friends. We're going to talk about pennants and breakouts of pennant patterns, and we'll be placing more example trades. So thank you so much for joining us today. I hope that you have found this helpful. Have an awesome day, and I will look forward to seeing you in a webcast coming up soon. Bye for now.